Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. Very good morning. Today will be Tuesday, the 30th of July, 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the intraday technical outlook on the major cross asset classes, let's have a quick recap what has taken shape yesterday in terms of these major cross asset classes performance, as well as any related data flow, and as well as key events to actually share with you all. Okay, so let us look at the performance of the cross asset classes yesterday, because yesterday we do not have any major economic data releases, both from the European session and as well as the US session. So let's have a quick look at the data. So what we could see yesterday is that it's rather of a mixed bag performance on an intraday basis. We do see SPX 500, the US major stock indices, which I'm focusing right now, managed to ink out just only a very tiny gain of 0.08%. The Nasdaq 100 is up 0.19%. The Dow Jones Industrial Average is down negative 0.12%, and the Russell 2000 underperformed negative 0.09%. So what we could see over here is yesterday is a rather a wishy-washy performance on an intraday basis on the major US stock indices. And if you look at the heat map of the S&P 500, it tells us a very similar story as well, a rather a mixed bag performance, where we start to see one of the mega cap technology stocks or the key component stock in the S&P 500 as well as the Nasdaq 100, which is NVIDIA, the leader of this AI optimism team play that market has started to question last week, is continues to be under pressure. Yesterday it was down negative 1.3%, but it managed to be offset by gains in the Microsoft positive 0.34%, as well as Google positive 1.45%. So net overall, if we look at the heat map of the S&P 500 as a whole among the mega cap stocks and in the rest of the other sectors, is rather a mixed bag story. So I would say it's a kind of a wishy-washy kind of performance. Why? Because of this week key risk event. So like I mentioned in yesterday's daily dose, this week will be a key risk event. Why? Because we see a slew of mega cap earnings. That means this mega cap US stock earnings that's been out this week: Microsoft, Apple, Amazon, and as well as Meta. They will actually release their earnings this week. On top of that, we also have macro-related risk as well, which is the Federal Reserve FOMC meeting outcome. More or less, the market participants will be focusing on Fed Chair Powell press conference on Wednesday, and which is Singapore time early Thursday. And ahead of that, we do have Bank of Japan monetary policy decision as well, which is out tomorrow. And notwithstanding, we also have on Thursday itself, we have Bank of England monetary policy decision. And to wrap up the week, we have the all-important US labor market or employment market data, which is the non-farm payroll that's out on this Friday. Okay, so net overall, what we could see over here yesterday is that the dollar as a whole managed to strengthen slightly. Okay, there was actually a push up in the dollar index, okay, above the 200-day moving average, and right now is attempting to actually break above the 20-day moving average. Okay, so right now during the Asia session, as we are speaking, the dollar index, so this is the US dollar index, okay, using as a proxy to gauge the overall average dollar strength or dollar weakness in the FX market, is now has inched up above the 20-day moving average. So there are some signs of we call it jittery in the FX market. where market participants may want to actually trim off their earlier dollar, so-called dollar short position as on the average, because this is a dollar index, so everything's be on the average. So with a risk of going up, retesting the 50-day moving average that's acting as a resistance at 104.88, and above it may see 105.20 over here. So the reason over here is that because more or less the FOMC meeting, if you look at the Fed Funds Watch, Fed Funds futures market as compiled by the CME Fed Watch 2, which I already shared with you all yesterday, as well as the following week, last week, market more or less has starts to actually price in that the first interest rate cut will come in September. But what after September over here, market has starts to price in a slew of expected interest rate cuts. That means, i.e., what we could see over here in the combined probability table. Okay, so this Wednesday, which is i.e. Singapore time, early Thursday, market is not expecting any change to the Fed funds rate. So no cut or no hike on this coming Wednesday, means i.e. Singapore time 2 a.m. Okay, on the Thursday at 5.25% to 5.5%. The huge change will come on the September meeting, 18th of September, where markets has starts to price in a high odds of 89% chance of the Fed will cut by 25 basis points. Then thereafter, we see a slew of high odds being priced into the Fed funds futures market, as well as being compiled by the CME Fed Watch 2. Another 25 basis point cut on the 7th of November FOMC meeting, which is a high odds of 71%, to bring it down to 4.75% to 5.5%. And another high odds right now of 63% that's being priced in on the 18th of December 2024 FOMC meeting, to bring it down further to 4.5%. And thereafter, we will stand pat in the January meeting next year. And another high odds of 83% to bring it down to 4.25% to 4.5% during the 19th of March 2025 meeting, and another high odds of 74% to bring it down another 25 basis point lower to 4% to 4.25% on the 30th of April meeting. So what we could see over here is that the pricing by the Fed funds market, or the Fed funds interest rate futures market, is indicating to us that after September, 18th of September FOMC meeting, the Fed will engineer the start of a 25 basis point interest rate cut cycle going down the road, or going down the month ahead into early the first half of the early first quarter of next year. All right, so what we could see over here is that market participants are getting expecting the Fed to be turning more dovish after September. But however, in the FX market, the participants are getting not so are getting a bit of cautious of pricing in this dovish tilt as being expressed by the Fed funds interest rate futures market. So that actually explained to us, we see the push up in the dollar index yesterday, telling us that market participants is very likely to actually trim, we call it short dollar position, ahead of the FOMC meeting this Wednesday. All right, because of this we call it rather dovish, I will put it in a way that rather high dovish pricing by the Fed funds interest rate futures market, indicating to us that after September, the Fed will start to engineer a interest rate cut cycle rather aggressively in terms of the way they actually conduct this cut cycle. That means almost every meeting there'll be a 25 basis point cut. All right, so but the FX market things likewise, so they feel that it's a bit jumping the gun way ahead. So they actually explained to us yesterday's kind of push up in the US dollar index. That means on the average we see some form of dollar short dollar position kind of get unwind ahead of the Wednesday FOMC meeting. Okay, so this is the price action that's being depicted by the FX market yesterday. All right, so and also one particular news flow I want to share with you all for today is China, from China. So China top policymakers right now, like I mentioned earlier in my daily dose, they are getting less emphasis, paying less emphasis to use the China financial market as a platform to promote growth. All right, because in order for the one way to promote growth in the China related financial markets, we got to have a slew of measures to encourage trading or investment. So yesterday they actually announced they will just stop publishing daily global stock flows by mid-August. So this is via the northbound, the Hong Kong Exchange link, the Shanghai Shenzhen Hong Kong Exchange link. That means, i.e., what they want to do over here is to actually further obscure information about overseas funds going out of its localized A share market. Okay, so very clearly, they are getting more and more, we call it evidence that is being played out by the action of the China top policymakers that the China stock market at this current, we call it a lackluster behavior or lackluster, we call it movement, because the China stock market has been lagging against the rest of the world since COVID-19, and even after the reopening of the Chinese economy, funds flows into the China stock market and as well as the performance of the China stock market as compared to the rest of the world continues to sluggish. So, but China top policymakers doesn't seem to be concerning about ways to actually pump up the China stock market, because their emphasis is right now heavily concentrated on a resource allocation towards high-end industrialization rather than boosting the confidence of the Chinese stock market. And yesterday's, we call it latest action by the China top policymakers to actually stop publishing overseas fund flows into China via the Hong Kong China Stock Exchange link further cemented this evidence that the China top policymaker primary what you call it, top objective right now is to push their high-end industrialization policy in China rather than policy to actually boost up the China stock market. So that means, i.e., with that being said, we do expect the Hong Kong stock market be so a proxy to the China stock market, and it's being impacted by the China economy as well, either directly or indirectly from a perspective. Very hard to start to see a major bullish uptrend that may take shape on the Hong Kong stock market from a medium term perspective. That means from the Hong Kong stock market, any potential rebound is just only short to medium term in nature rather than the start of a major bullish trend, given this current latest news flow that is out from China top policy maker, their mindset perspective that are trying to decipher. All right, so with that, now let us now move on to a medium-term intermarket dynamics perspective. So today, intermarket dynamics, I want to focus more on the US stock market instead. Why? Because of the release of the mega cap technology stocks that are actually due this week. So at the end of today US session, you will see the release of this Microsoft. Okay, Microsoft. Okay, so let me scroll all the way up for today's. Yes, over here. So for today, we will see the release of Microsoft earnings for Q2 at the end of the US, after the closure of today's US session. That means, i.e., the timing will be after 4 a.m. Singapore time tomorrow. All right. So market is expecting a slight uptick in earnings growth compared to the previous quarter 1 year ago. Previously, as what $2.69 EPS 1 year ago, and right now market is expecting 2.94%. But the concern over here is they are looking towards Microsoft investment in ChatGPT, and also going forward the earnings guardians in their services. All right, the suite of services that Microsoft offer, especially towards the AI arena, things. All right, but let me share with you all from a technical perspective on Microsoft share price. Why is it important? Because Microsoft is the #1 market cap stock on the S&P 500 and the #2 market cap stock on the Nasdaq 100. Whatever that share price movement could impact tremendously on the Nasdaq 100 and on the S&P 500 from a short-term perspective. All right, so now let us take a look at the chart of Microsoft. Okay, so this is a chart of Microsoft over here. This is the daily chart. So what you could see here on the daily chart is still trading within its major ascending channel that I drew from the low of 4th of January 2023. All right, still within. But however, the medium-term uptrend seems to be at its damage. Why? Because it's trading below the 50-day moving average, right? The 50-day moving average. And what we could see over here is that yesterday price action also shaped a bearish candlestick right below this 50-day moving average that is acting as a resistance. Okay. Okay, at around 440.45 over here. So right now there is a key support level to watch, which is at 404.51, which correspond to very closely to the upper limit, the lower limit of the major ascending channel, but our the swing low of 31st of May and the 200-day moving average. This is in orange line over here. And if you were to look at the weekly time frame, the longer term time frame, what we could see over here is that the RSI has started to flash out a bearish divergence. Okay, bearish divergence. And if I were to actually locate the swing low of the RSI that is acting as the support level, which is also very in parallel with the major ascending channel support over here that I drew on the price action in turquoise blue. Here I try to connect the higher lows. You realize that the RSI parallel support level that also links to the swing low of the minor ascending channel support has shaped a bearish breakdown, giving us a pre-bearish signal on the price action of the Microsoft from on a weekly time frame. Why is it a pre-signal? Because RSI is a derivative, is something measurement of a rate of change. Anything that is a derivative will tend to give a bit of leading signal ahead of the price action. So what the RSI is telling us right now on the weekly chart is telling us that the major uptrend momentum is no longer bullish, but however, there could be a risk of a bearish breakdown or the risk of a change of trend of this medium-term uptrend. Not medium term, the major uptrend. That means indicating to us that this major uptrend over here is at risk of breaking down and shaping a significant correction to correct this previous up move previously. All right, so what you could see over here, if we go to the daily time frame over here, that means there is actually a risk right now if the price action on Microsoft starts to break down this 404.51, then from a multi-week perspective, there could be a risk of a further medium-term downtrend unfolding on the price action of Microsoft, which is detrimental to the S&P 500 and the Nasdaq 100 if 404.51 breaks down to the downside. Okay, and also given the fact that any push up in price action on an intraday basis tomorrow, because tomorrow the price action I could actually gap up first, as long as it didn't gap up, there's this resistance level to watch with 440.45, 446.41 in the aftermarket. All right, because price could actually swing wildly during the earnings release over here. So these are the two key levels to watch out for as the markets ahead of tomorrow Microsoft earnings announcement. But the weekly chart on Microsoft is telling us a warning sign that this major uptrend phase from the low of January 2023 is at risk of shaping this medium-term corrective decline sequence because of the weakness that I share with you on the weekly RSI. Okay, so that's the intermarket relation with Microsoft that it could translate down to the Nasdaq 100 and the S&P 500, given that it has a significant weightage in them. And right now, as a whole, let's us look at the relationship between the VIX and the move index. So this VIX index, we know that is an implied volatility on the S&P 500. If the implied volatility on the S&P 500 starts to inch higher, that means there could be more further downside on the S&P 500 because the implied volatility has increased. That means there is some form of fear factor that's coming back into the play of the market. And this particular red line here, or we call it dark pink line, is the move index. So this is the implied volatility on the fixed income market in US, the US Treasury market as per se, not the corporate bonds, the US Treasury bonds. That means, i.e., if the move index starts to move up higher, that means we start to see the bond pricing, bond prices on the longer end starts to come down. But most interestingly, right now I'm trying to share with you all the volatility difference between the VIX and the move. So I could see over here in the last few weeks since June, all right, since June, that means about 2 months back, since 2 months ago, I mean since June, right? The since June, because now we're coming to end of July already, so about 2 months. The difference between the VIX and the move index, the difference starts to get compressed. Then what we could see over here is that I plot the difference by getting VIX divided by the move. So what I could see over here is that the VIX is actually moving at a faster rate compared to the move index. That means, i.e., the volatility in the stock market is actually now picking up at a faster rate. The implied volatility picking up at a faster rate compared to the implied volatility of the move index. And if I were to actually plot this behavior against the behavior of the S&P 500, okay, let me open up the chart. Okay, so at the bottom over here is the S&P 500 in pink. All right, so notice that over here the VIX and move index has started to shape a higher low, right? That means indicating to us the movement of the VIX is moving at a faster pace than the movement of the move index. And if you look at previously in the past over here, when this thing happened, okay, this is the weekly chart. Okay, it picked up steam, very similar to what we see over here. The S&P 500 shaped a decline. So that was during a significant decline, correction, a significant corrective move. So that was happened during the COVID period itself over here. And interestingly, what we see over here as well, this was during December 2011 to September 2022. So that was also the fear of inflation coming back into the US economy at that point in time. And during that point in time, if you were to look at the difference between the VIX divided by the move, it also shaped this kind of higher low, okay, prior to that multi-month corrective decline. Okay, and the most recent one was in July 2023, last year, the multi-month corrective decline, to October 2023. Okay, this branch here, we realized that the movement of the VIX divided by move also shaped that higher low. Okay, and right now this kind of observation has started to seen as well. Okay, so i.e., that means what this particular element is telling us that based on the previous movement of its impact on the S&P 500, the VIX right now is actually moving at a faster rate compared to the move index. It could translate to a potential multi-month corrective decline on the S&P 500, and that could potentially be triggered by this week earnings release or earnings guidance of this mega cap technology stock. So this is a kind of a put it away that it's something in terms of traffic light, right? This is something like a amber light, amber light that is flashing to us right now, indicating there could be an increased risk in the volatility of the VIX much more than the move index, and it could have a negative impact on the S&P 500 as shared with you all by its previous price action behavior in correlation as a leading signal with the prior corrective move that has taken shape on the S&P 500, and the duration of the previous corrective move on the S&P 500 came from a multi-month perspective. That means it's a longer time frame. All right, over here. Okay, so this is the intermarket dynamics that is taking shape right now, in very interesting dynamics that I want to share with you all. All right, so with that, now let us now shift our focus to the intraday technical outlook on the major cross asset classes, starting with the FX market first. All right, so before that, let me expand my screen so that you guys can see the levels much more clearer. All right, so I hope that everything is good. There's no sound disturbance, all right, because I think there was just a kind of a sound disturbance earlier a while ago. Okay, so now let's take a look at before we jump into the short-term intraday technical outlook on the euro dollar and the other major dollar pair. This is the 5-day rolling performance as of now we are speaking. So what we could see over here is that previously the dollar was the weakest against the Japanese yen, and this dollar weakness against the Japanese yen, the gap has started to cover. As you start to see that it's now moving in line with the other dollar major pair. All right, like the dollar CAD, the dollar sterling, the dollar euro, the dollar CNH, the dollar CHF. All right, so net overall, this dollar weakness against the Japanese yen, at least from a short-term perspective, the weakness has started to actually mean revert. All right, so later what it means that over here, that also explained to us why the dollar strength actually came back yesterday as well from an intraday basis, more or less likely also being contributed by this prior dollar yen weakness, mean reverting towards the other dollar major pair. Okay, so now with that, let us now jump straight to the euro dollar. Okay, so euro dollar yesterday we do place a very tight pivotal support right exactly at the 20-day moving average at this 1.0830 level. Price action clearly breaking down below it, and right now it actually shape a series of hourly closes right below the 20-day moving average, now acting as a resistance. So what we could see over here is that the price action on an intraday basis seems to be skewing towards more of the weaker side of the story for the euro dollar, rather than looking for a potential further bounce on the euro dollar on the intraday basis. So with that, we will be using the 20-day moving average, which is the 1.0850 as my short-term pivotal resistance for today. We'll be flipping to a short-term intraday bearish bias instead, due to yesterday's weak price movement on the euro dollar. First support level to watch on the intraday basis, 1.0805. A breakdown below 1.0805 exposes 1.0770. Only an hourly close and a push up above 1.0850 will invalidate today's intraday bearish bias on the euro dollar to see the reinstatement of the push up scenario to unfold again on the euro dollar, to test the next near-term resistance level at 1.0880, followed by 1.090 on the intraday basis. Then what's for the sterling dollar, very similar price action as well. It also squeezed down below the 20-day moving average yesterday, and what we could see is that during the US session, it actually did a bearish reaction of this 20-day moving average as well. So with that bearish price action that has taken shape on the intraday basis yesterday, the odds now also seems to be skewing towards more on the weaker side of the story for the sterling dollar on an intraday basis, rather looking for a recovery scenario to take place on the sterling dollar. So with that, yesterday price pushed down below the 20-day moving average has invalidated our intraday bullish bias for yesterday. We will flip to a bearish bias for today instead, using yesterday's swing high area, which is very close to the 20-day moving average at 1.2890. That will be my short-term pivotal resistance for today, and also it continues to shape a series of lower high right below this dotted gray line here, which is the former bullish breakout. Then thereafter it cannot turns into a positive momentum and starts to trend lower below this dotted gray line, indicating to us that the previous breakout of 12th of July is a failure bullish breakout over here. All right, a failure bullish breakout. So using 1.2890 as my short-term pivotal resistance, we will flip to a bearish bias for today on the sterling dollar. First near-term support level to watch on the intraday basis, 1.2680, which corresponds to the 50-day moving average. A further breakdown below this level exposes 1.27 figure level, which was the minus swing high area, former minus swing high area of 25th of June and 2nd of July. Only an hourly close and a breakout above 1.2890 will invalidate today's bearish bias on the sterling dollar to see the recovery scenario reinstating on the sterling dollar to expose the next near-term resistance on an intraday basis at 1.2940 followed by 1.2990. Moving on will be the Asia Pacific dollar pair. Let us start off with the Aussie dollar. So Aussie dollar, yesterday we do have a bullish bias, but hoping with the first resistance at 65.80, but thereafter we do see the price action hesitant right below the 65.80 level, all right, as it continues to trend lower by this lower high, a slight lower high over here. Okay, so with that lackluster price action on the Aussie dollar, and together with the dollar strength that is starting to actually creep back into the European currency, which i.e. the euro and the sterling, we will have a very low conviction that the Aussie dollar may start to surpass above 65.80 to shape that mean reversion rebound scenario. So given the lackluster movement of the Aussie dollar, we will flip back to a bearish bias using 65.80 as my short-term pivotal resistance level. We also correspond to the 200-day moving average, acting as a ceiling as well on the price action of the Aussie dollar as we're speaking right now. First support to watch out for will be 65.20. A breakdown below 65.20 exposes 64.65 level, which is the minor swing low area of 1st of May, and as well as the previous push up 19th of April all the way up to 11th of July, the 76.4% Fibo retracement, which is corresponding at 64.65. Okay. However, only an hourly close above 65.80 will invalidate today's intraday bearish bias on the Aussie dollar to reinstate back the mean reversion rebound scenario to expose the next near-term resistance on the intraday basis at 66.10 followed by 66.40. Okay, that's for the Aussie dollar. The dollar yen, so dollar yen, since Friday we do have that bullish bias, so price action going to trade sideways. Yesterday it has since 4 tests at the 15410 level, and what's interesting, the hourly RSI continues to trend higher, shaping higher low. All right, over here indicating to us there's some form of bullish momentum that is still intact on the dollar yen, at least on a intraday basis using the hourly chart. So no change, still using 15. I don't put it so tight over here at 152.85, which is close to yesterday minor swing low area. So this will be a first support level to watch as it trades sideways. As long as this 151.70 short-term pivotal support level continue to hold, which is the 200-day moving average as well, a breakout above 15410 will increase the odds of this mean reversion rebound scenario on the dollar yen to expose the next near-term resistance zone at 155.80/156.50 on a intraday basis for today on the dollar yen. So still maintaining that short-term intraday bullish bias for that potential mean reversion rebound scenario to play out on the dollar yen after last week's decline. However, if we start to see a breakdown below 151.70, that means the price action came down, breakdown below 151.70 with an hourly close below it, then this impulsive downward sequence will resume for the dollar yen to actually resume its short and medium term downtrend to actually expose the next near-term support level at 1580/40, followed by 150 figure level /14950 level next. Okay, so that sum up for the intraday technical outlook on the FX market. Now let us let us shift our focus now to the intraday technical outlook on the major stock indices. Okay, starting with the Hong Kong 33, the Hang Seng Index. So the Hang Seng Index continues to actually trade lower below the 200-day moving average at the start of today's opening session, but managed to held up above yesterday's short-term pivotal support, which I highlighted at 16,970. And given today's intraday bearish movement below the 200-day moving average, we will actually flip to a neutrality stance for today between 17,200 and 16,970, which was yesterday's short-term pivotal support, more like a sideways movement instead for today. As long as price action remains kept between this range, you're likely to trade sideways. But however, if the price action now starts to shape a breakdown below 16,970, then this minor impulsive downward sequence will resume to expose the next near-term support level at 16,840, followed by 16,620 next on the Hong Kong 33 or the Hang Seng Index. Now flipping will be the Japan 225 or the Nikkei 225 next. So the Japan 225 and Nikkei 225, yesterday we do have a bullish bias, but it failed to break above the first resistance at 38,750 and continues to inch downwards. And what we could see over here is that the hourly RSI has also turned bearish as well, as it continues to trend lower below the 50 line, indicating to us that bearish momentum has started to reinstate on the Nikkei 225 or the Japan 225 on the intraday basis. So with that, I'll be using 38,750 as my short-term pivotal resistance for today on the Japan 225, flip to a short-term intraday bearish bias. First support level to watch for today will be at 37,630. A breakdown below 37,630 exposes the next near-term support. We also confluence with the 200-day moving average at 37,105 next. Only a push up with an hourly close above 38,750 will invalidate today's intraday bearish bias on the Japan 225 or Nikkei 225 to see the recovery scenario reinstating back into the Japan 225, firstly for a retest on the 50-day moving average, also acting as a resistance at 39,350. Above it sees 40,050 coming next, which also correspond to the 20-day moving average acting as a resistance level as well. Okay, that's for the Japan 225. Now moving on will be the European stock index, which is the German 30. So the German 30 failed to actually shape that rebound upwards towards the 18,630 level, and instead it reintegrate back below the 50 and the 20-day moving average, indicating to us short-term weakness has started to creep back on the German 30 index. So I'll be using this level here, 18,430, which confluence with yesterday's breakdown level, which is also the 20 and the 50-day moving average acting as a resistance level as well. So as long as 18,430 short-term pivotal resistance didn't surpass today to the upside, potentially the German 30 may shape further weakness to actually retest the lower limit of this expanding wedge configuration that is in place since 14th of June by this purple line over here. First support level to watch 18,150, a breakdown below 18,150 exposes this 18,050 level. Okay, 18,050 level, which is the minor swing low of 19th of July, June, 26th of June, and 2nd of July. Only an hourly close back above 18,430, then we will reinstate back the intraday bullish bias again towards the upper limit of the expanding wedge to retest 18,520, followed by 18,630 level. Okay. Now, moving on will be the major US stock indices, starting with the US Wall Street 30. So yesterday, the US Wall Street 30 managed to actually came down. Okay, it came down, retested the short-term pivotal support level at 40,380 yesterday, then ship a bounce. Then thereafter, it can't have a positive follow-through and trend lower throughout the remaining of the US session towards the close. And if we look at the hourly RSI over here, the hourly RSI has also broken down below a trend line support level, okay, itself over here, and trend lower by shaping a series of higher low right below the 50 level mark over here, so indicating a lack of upside momentum at this juncture on the US Wall Street 30 or the Dow Jones Industrial Average. So with that, right, with this lack of upside momentum, the conviction for it to actually shape a breakout above 40,800 level to test the 4150, 41250 level, the conviction or the odds seems to be low right now based on the latest short-term technical element that I highlighted on the hourly RSI. So with that, low conviction to maintain that short-term intraday bullish bias that we have for yesterday. So for today, we'll flip to a neutrality stance instead on the US Wall Street 30. So more like a sideways neutrality range between 40,380 and 40,800 for today. Only an hourly close back above 40,800 will reinstate that short-term intraday bullish bias again to expose the next near-term resistance of 41,050, 41,250. All right, so neutral for now on the US Wall Street 30. Now, moving on will be the NASDAQ 100. And given that potential bearish, we call it elements that has been cited, or I share with you all on its key component stock, which is the on the second biggest weightage stocks in the NASDAQ 100, which is Microsoft, ahead of the earnings released today at the close of the US session. The price action of the NASDAQ 100 yesterday failed to break above the first resistance at 19,230, and also the RSI also break down its former ascending trendline support level as well, indicating a short-term downside momentum has started to creep back into the NASDAQ 100. So with that, we'll be flipping back into a bearish bias again on the NASDAQ 100 as it continues to actually trade within this minor descending channel that I drew from its all-time high of 11th of July. So as long as 19,230 short-term pivotal resistance holds for today, potentially there could be some form of further weakness on the Nasdaq 100 as it continues to evolve in this minor ascending channel, given the downside momentum has started to creep back on the hourly RSI by the breakdown of this ascending channel and continues to trend below the 50 level mark. First support level to watch, 18,650. That will be the first support level, which also confluence with the lower limit of this minor ascending channel. Only a breakdown below 18,650, then potentially we could see a further deceleration to expose the next near-term support at 18,390/18,360. However, only an hourly close above 19,230 will invalidate today's intraday bearish bias on the Nasdaq 100 to see the start of a mean reversion rebound scenario unfolding for the Nasdaq 100 to expose the next near-term resistance of 19,520 followed by 19,780. Okay, so that sum up for the intraday technical outlook on the major stock indices. So now let us now focus on the major commodities, starting with gold XAU/USD. So for gold XAU/USD, yesterday we do mention that it may start to shape a minor slide first, and the slide did take shape and also hold right exactly at the Titan 2,373 short-term pivotal support that we highlighted yesterday. And also we are speaking right now, the hourly RSI continues to shape a series of higher low and managed to hold at this parallel support over here, which was that bullish divergence initially on Friday. So with that, still no change, still use 2,373 as 2,373 Titan short-term pivotal support that we have yesterday remains the same pivotal support for today. Maintain that short-term intraday bullish bias on gold XAU/USD. However, I do have a slightly lower first near-term resistance level to watch on the intraday basis will be at 2,395 level, this red line here, 2,395, which also correspond to the 20-day moving average. A break above 2,395 sees the next near-term resistance to come in at 2,411 on the intraday basis. However, only a breakdown of the hourly close below 2,373 will invalidate today's intraday bullish bias to see the continuation of this minor corrective decline to expose last Friday minor swing low at 2,353. A breakdown below it exposes the next near-term support at 2,337 next. Okay, that's for gold XAU/USD. Now moving on, lastly will be the West Texas crude oil. So West Texas crude oil yesterday, due to mixed element, we were neutral between 77.25 and 78.90. So yesterday price action clearly break down below 77.25, and right now it's actually indicating that the price action continue to oscillate within this minor descending channel in pink that I drew from the intraday high of 18th of July. The Hourly RSI only continues to show signs of weakness over here. No signs of a bullish divergence, as well as it continues to trend lower over here by shipping a series of lower high. Okay, so with that, we will flip to a bearish bias on West Texas oil for today, given that yesterday is broken down below the lower limit of the neutrality range, using 77.25 as my short-term pivotal resistance for today. As long as any bounced in, reintegrate back above 77.25, flip to a short-term intraday bearish bias for West Texas crude oil. Next near-term support level to watch will be at 75.46, followed by 74.76, which is close to the lower limit of this minor descending channel, and as well as the 2-time Fibo extension that I drew from the high of 5th of July, project it to the low of 16th of June, and place it up to the minor swing high of 18th of July, give us the 2 times, and as well as this minor congestion area over here from 6th of June. Okay, only an hourly close or reintegration back above 77.25, we will invalidate today's intraday bearish bias on West Texas crude oil to see a choppy movement upwards again to retest the 200-day moving average that is also acting as a resistance at 78.90 on the intraday basis. All right, if 77.25 is taken up on the upside for today. Okay, so that sum up for today's intraday technical outlook on the major cross asset classes. So before we go, other than Microsoft, what other key data or news to look out, or key economic data to look out for today? So today is Tuesday. So over at Tuesday over here in the European session, we do have a slew of flash GDP data releasing Q2 for Germany at 4 p.m. Singapore time, and 1:30 p.m. Singapore time. We have the France flash Q2 GDP growth data that is released as well. And for the Eurozone as a whole, it will come out slightly later at 5 p.m. Singapore time. All right. So these are the 3 key European related data to take note of. Basically, is the Q2 flash GDP data from France, Germany, and the combined one, the Eurozone, out at later time at 5 p.m. And over here, then thereafter, we also have preliminary July flash inflation rate as well, out from one of the major Eurozone economy will be Germany, out at 8 p.m. Singapore time. All right. And also right in the US session over here, we do have 2 data to look at. Will be the house price index out at 9 p.m. Singapore time, followed by the conference board consumer confidence for July out at 10 p.m. Singapore time. All right, then thereafter will be the all-important Microsoft earnings, which will be released after 4 a.m. Singapore time, i.e. after the closure of today US, we call it a session for the stock market. Okay, so with that, that sum up today's daily dose of market insights. I'm Kelvin here, signing off. Wish you all a great day ahead, and we shall speak again tomorrow. Thank you.